Hey everyone, welcome back to Corporate Decoder. Today, HF Holdings Incorporated just filed its quarterly report for the 30th of June 2026, and I am seeing some serious red flags here, particularly around its ability to stay listed on the stock market. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is teetering on the edge of being delisted, and its financial health is looking quite shaky. So SHF Holdings Incorporated, trading under the ticker symbol SHFS.W, is essentially a financial services company that helps banks work with cannabis-related businesses. Because cannabis is still illegal federally in the US, most banks are scared to touch these businesses. HF Holdings acts as a middleman providing compliance and risk management, so banks can serve these companies. Let's dive straight into the numbers. As of the 30th of June 2026, SHF Holdings had total assets of about $14.1 million. That sounds okay, but look at their liabilities. They owe over $8 million. That means they have less than $6.1 million in what is called stockholders' equity. And the bleeding doesn't stop there. For the 3 months ending the 30th of June 2026, they lost nearly $2.5 million. For the 6-month period, that loss jumped to over $4.3 million. This is a lot of money for a company this size. In fact, they have an accumulated deficit of over $126 million. Their revenue streams include account fees, loan program income, and investment income. For the 3 months ending the 30th of June 2026, total revenue was about $1.9 million, which is up slightly from last year, but their expenses are much higher, eating up all that revenue. And then some. Total operating expenses for the 3 months ended the 30th of June 2026 were almost $3 million. That is up from about $2.8 million last year. The biggest culprits are general and administrative expenses, which shot up by over 93% year over year. This is a massive jump and signals a lot of spending is happening. Looking at cash flows paints an even grimmer picture. For the first 6 months of 2026, they used $2.8 million in cash for operations. That is more than they used in the same period last year. They have a serious cash burn problem. This is where things get really concerning. The company itself admits in the filing there is substantial doubt about its ability to continue as a going concern. That is a polite way of saying they might not be able to pay their bills for the next year. They have recurring losses, negative cash flows, and a massive accumulated deficit. Their total assets are only $14.1 million, and they have liabilities of over $8 million. They've got less than $5 million in working capital. This is tight, especially when you consider the legal issues and the potential for more losses. Their primary financial institution partner, Colorado Credit Union, is a big part of their business. They make a lot of their money from this partnership, but it also represents a huge concentration risk. If anything goes wrong with this relationship, they could be in serious trouble. Now here's the real kicker. SHF Holdings is at risk of being delisted from the NASDAQ stock market. On the 22nd of April 2026, they received a notice that their stock price has been below $1 for 30 consecutive business days. They have until the 19th of October 2026 to get their stock price back above $1 for at least 10 consecutive days. This is particularly worrying because NASDAQ is planning to implement a new rule that would delist companies whose market value falls below $5 million for 30 consecutive days. This rule is currently on hold, but if it goes into effect, it could mean immediate delisting for AHF Holdings. This is similar to what happened to many companies that tried to recover from a reverse split and couldn't maintain their stock price. Think about companies like Kodak back in 2021, where holders saw significant further losses after a reverse split, a pattern that often leads to delisting. Adding to their problems, they are involved in a significant lawsuit related to their acquisition of Abaca. A court ruled that a key amendment to the merger agreement was invalid. Damages are still being determined, but the potential loss could be up to $7.8 million. This is a huge amount for a company with such limited resources. The company also has material weaknesses in its internal controls over financial reporting. This means they are not confident that their financial statements are completely accurate and that errors could be missed. While they are working on fixing these issues, it adds another layer of risk. Overall, SHF Holdings looks like a company struggling to stay afloat. They are burning cash, have significant liabilities, are facing delisting from NASDAQ, and are embroiled in a major lawsuit. The cannabis banking sector has potential, but SHF Holdings appears to be in a very precarious financial position. The risk I am watching is their ability to regain NASDAQ compliance and avoid delisting, which historically has been a death knell for many smaller companies. What I'm actually looking for is a clear path to profitability and a significant improvement in their cash flow. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Check out the Discord in the description.